Okay, everybody. How's everybody doing? Just give us a quick minute or two. We were just able to get on the Zoom meeting. It looks like there was another Zoom class that was going on. So we're just now getting a chance to, get everything kicked on. So just bear with us for one more moment here and then we'll get everything started.
Okay. Good morning, everyone. Okay, so do you want to go over this first?
We should probably go. I think the taxes thing is probably, we should probably just hit that first because that's part of the funds that you can use. And then I'll just get into some in the DPA programs, and then I'll just get into some of the other types of, forms that we can use.
Okay. All right, so it's 10:04. Okay, so we should probably get started. Everybody should be here. So, all right, so definitely wanted to host this class today and just kind of talk about the down, like what the customers have available to them to put for their down payment. I would tell you that almost every pre-approval conversation I have with clients, like they just don't know their options or what they can do. And they need kind of guidance. So I figured it would be a good class to have. We could talk, if you guys are educated on it and we can educate the customer, that will be more deals for all of us. So this is a really important time right now to talk about taxes. So Cliff just talked about our 1099 program that we just launched. And basically, if a customer is self-employed and they are 1099, we can utilize 90% of their income for qualifying them. Just wanted to throw that out real quick again. I know we already kind of talked about it, but I just wanted to kind of throw that out again too. Those are kind of situations where the customer wouldn't qualify otherwise. So if we were looking at their regular taxes and they have too many write-offs, this is going to be a program that would be eligible for them. So when we are doing our pre-approval, to kind of jump back to the taxes, so what we do is we talk to the customer about where their funds are coming from. So what kind of funds do they have available for their down payment? So most customers don't realize that they can utilize their tax returns, and it's really important to make sure that they don't use that money before we talk to them. So a lot of the times customers, when they get their tax returns, they want to pay off debt, right? They're like, we have this money, we want to pay off debt. So we're going to take the tax returns and pay off a credit card or whatever it may be. We're trying to have these conversations up front before they pay anything off, because sometimes it's better to have their taxes in their bank account for reserves or additional assets. So let's just say the customer is getting $5,000 back. We would take a look at their financial profile and go over, okay, would it be better to pay off a credit card, or do we need to keep that $5,000 in the account to have an additional month of reserves? Does anybody know what reserves are? Okay, so I use these terminology
topic.
sometimes and I forget that
Yeah.
like we don't know. So reserves are what the customer has in their bank account after they've covered their down payment, their closing costs, and their homeowner's insurance. Those are the three main charges that a borrower has, is closing costs, down payment, and homeowner's insurance. So when we are quoting a customer for their cash to close, we go over those three items. So let's just say the customer was purchasing a $100,000 house and they were going FHA. They would have their 3.5% down payment, which would be $3,500. Let's just say $5,000 in closing costs, and then $1,000 for homeowners insurance. So they would be about $9,500 out of pocket. So when we're having that conversation with the client and say they only have $5,000, well, then we know that they need to ask for closing costs from the seller, or they can't purchase the house, and they have to utilize one of the sources that we're going to talk about today. Right now, I would say 7 out of the 10 conversations that I'm having with the client is, oh, I have my tax return coming. So they might have $1,000 in their bank account. Now they're getting the tax return. So if they had that $9,500 in their bank account, a reserve would be 1 month of mortgage payment in their bank account after they've paid for those three things. So say the mortgage payment was $1,000, they would need $10,500 if we go back to the example. So example is $100,000 house, 3.5% down, which is $3,500, $5,000 for closing costs, $1,000 for homeowners insurance. They would need $9,500 to bring to closing. And if their payment was $1,000, the reserve would be that extra $1,000 in their bank account. So they would need $10,500. So I know you guys hear a lot of us the time talking about how CrossCountry can utilize lower credit scores. The most of the time we can get an approval with 3 months of reserves. So in that particular case, the client would need to have an extra $3,000 in their account at closing after all of their expenses were paid. The amount of reserves depends on the client's profile. The lower the credit score, the more reserves that the client needs. Now, I will tell you, a lot of loan officers don't know this little trick. Because I have people come to me all the time that they didn't get approved at another lender. And when I just add the reserves, they get a qualification, whether it's 1 month, 2 month, 3 month. So it's important to have that conversation, because they might already have their amount saved up. And let's say they don't qualify now. And then we say, hey, do you have your tax return coming? And they're getting an extra $5,000 that could cover the reserves.
So that just needs to be, I'm sorry, in their account so that you can see that.
Yes, that's
Right.
correct. It just needs to be in their bank account at the time of closing. So they can get a gift for those funds a lot of the times, or we can use 401k. So if they have access to their 401k and they don't have to physically pull the money out, but the 401k still counts as reserves. So right now with taxes, a lot of the times we don't even have to utilize the customer's tax returns if they are a W-2 employee. So that means if they get paid hourly or their salary and they get a physical W-2, we don't even need to collect their tax returns. That's one good thing about CrossCountry, is that we use bare minimum qualifications. So if Fannie or Freddie or FHA guidelines take it, we take it. The only time we have to collect their tax returns is if they are using, they have overtime or commission income, and then we need their tax returns. So right now with just the W-2s coming out, it's easier sometimes just to qualify them off those W-2s rather than collect their tax returns. If they are self-employed or then obviously we need 2 years. And then if they are, right now, we're kind of in this gray area until April 15th. And so if they close prior to April 15th, we do not need their taxes for 2022. We can still utilize 2020 and 2021. If they close after April 15th, we need either a copy of their extension showing that they filed an extension, or we need their full returns. So that's kind of stuff that we deal with this time of the year is, are their taxes going to be filed before, or do we need to wait for after? So like if you're setting your closing date, this is something definitely, like, as we get closer to April and you know your customer is self-employed, definitely have that conversation with your lender, because we've seen some situations where like when we got the contracts and they were closing afterwards and they weren't going to have their taxes filed, and then we've had to file for extension. So this is definitely a good time of year to make sure that you're utilizing that. If the customer if they owe on their taxes, so let's just say they file their tax returns early and they owe on their taxes, they have to have their taxes paid before they can close, or they have to have a payment plan set up with the IRS. So you can't be behind on federal debt when you're getting a mortgage. And the reason being is if you owe the IRS money and you don't pay them, they can slap a lien on your house. So the mortgage lenders can't give money to somebody that owes the IRS, especially if they're back taxes, or unless they have an accepted payment plan with the IRS. The great part about that is right now there's a new tool on the IRS website. So if the customer does owe money, they can just log right on and schedule it. They can input the amount that they owe and it will automatically generate a payment plan, and we can use that for qualifications.
It's huge.
It's really helpful in all
Saves a lot of
Harvard.
time.
Yes. And then also if the loan programs are a little bit different. So if it's FHA, the customer has to make 3 of those payments so we can see that they've made them on time. So say they go online, they schedule the IRS payment and they haven't made 3 payments. With an FHA loan, we can't close until they've made that 3rd payment, and they can't pay 3 months at once, because we've tried that trick a ton of times too. FHA is just a little bit more strict, where they want to see that the customer has made those payments consecutively. The nice part about conventional is that they only have to make 1 payment. So if they make 1 payment with that payment plan and they can make it in the month that they're closing, we can utilize the payment plan that they set up with the IRS, and we can get that added to their debt to income ratio. I caution this, like, because most people that we talk to never tell us that they owe money to the IRS. They just don't, for some reason. I think that they think that we're not going to find out about it. I don't know why, but it's something that, like, we have to run, fraud reports and things like that. And then we always find out if they owe money. So it's just one of those things that I ask it at every pre-approval. It's a standard declaration question that we have to ask, but the majority of the time we get, oh, I was going to pay those, or I don't think that they're doing it to be deceitful necessarily, but it's, so if you hear any of your clients ever saying like, I owe taxes or I have to pay my taxes, make sure you're talking about that with your lender, because it could definitely blow a deal up. So that's the kind of gist on taxes this time of the year, and just asking every client if they have tax returns coming to utilize it for a down payment. A lot of the times people will use their tax returns over the grant programs. And I'm going to show you guys, I'm going to talk a little bit about OFA, because I think that this time of the year, and I don't know why, people are just either short on funds. I don't know if it's because of Christmas or whatever it may be, but this time of the year, we see more tax returns and grant programs being utilized than ever. So I'm going to share the OFA screen and kind of talk about OFA for a little bit. And then Cliff is going to talk about another program that we have as well, and then go over some of the other acceptable sources of a down payment. So let me see if I can share my screen here. And I have a lot going on.
Yes. Yes. Oh, that's right. Yeah, you joined us a little bit late. So here's a couple of things that I'm going to discuss.
Thank you.
One real quick thing, guys, too, while Jess is pulling that up on tax returns. Okay. When a borrower gets their tax return in from the IRS,
Can you
okay?
guys, on Zoom, can you guys
Can they
see
see?
this? Do you guys see the OFA screen?
Yes.
Okay, great.
Okay, great.
Okay, but in regards to tax returns, one important thing that we're gonna make sure that we have to finalize and figure out what the borrower is. So say, for instance, they file their tax returns, through TurboTax, through, H&R Block's site or whatever they want to do, and they did it themselves, okay? And instead of paying for the cost to do that, prepare those tax returns yourself, like say it's like $80 to prepare them yourself. A lot of the times the clients, they take the easy way out and they just have that $80 coming out of their tax return, okay? Now that's an important thing because when we're verifying taxes, that amount has to match up that your actual tax return is, and then what gets deposited into your account, whether it's via direct deposit, via check or something like that. They need to make sure that matches up to what they received. And sometimes if a client is having their money that they paid coming out of that, it'll be an $80 difference and it doesn't match up. So now we have to incorporate, okay, a letter of explanation. We may have to show the receipt of the cost for that transaction just to make sure that it matches up, because sometimes that can be another thing that can be held up with, a person's, cash to close. But once again, this is the things that Jessica and I make sure we educate and talk to them about it, so they're not freaking out and not knowing what to do. And they're like, hey, my money's there. Why aren't you using it? Because no one explained to them the process. And then you get just an unwanted frustration that doesn't need to be had. Okay, so just things like that, just to consider.
Yeah, and also too, like we will definitely get a little bit creative. I've done this with multiple borrowers. And I'm not saying that it's like the best way to utilize a pre-approval right now, but we all know like business is a little bit lower. We're trying to get creative with getting customers under contract. If the customer has their taxes filed, we can see on the bottom of the tax return how much they're getting. Like, I don't know if you guys know from like your personal tax returns, like if you ever looked at them on the second page of your 1040, it shows the amount that you're receiving. So we can verify that the customer has filed their taxes. We know how much money they're getting. We know that it's just on the way. So I wrote like 60-day closings before, and the customer doesn't physically have the money in their account yet, but we know that they're filed and we know that it's coming. And if we're, upfront with the listing agent and saying, hey, like we're writing the 60-day closing because the customer's taxes are on the way. Are you open to this? I think I have like 3 or 4 under contract right now from that. So I think it's definitely times where we do have to get a little bit of creative, and like banks aren't going to do that. Like, because they're like, no, the money isn't physically in their account. They're not going to get creative with their realtors and try to like get stuff under contract. So just keep that in mind too. The customer doesn't have to physically have the money in their bank account for us to issue the pre-approval letter and get them under contract. Now, the risk is obviously, we know the IRS and we know that if there's for some reason there was a delay and they don't have their money like they were supposed to, it could delay closing. But I think just being upfront with the listing agent and writing that somewhere or having a verbal conversation about it. People want to go under contract right now, so they're willing to get a little bit more lenient as far as that kind of stuff too. So just that's one of the biggest takeaways is I wanted to make sure everybody knew today too. Like we will push those pre-approvals through and try to help the customer get under contract. But to go back a little bit to the OFA website. So this is what I use daily. So OFA is a grant through the state of Ohio that gives the customer assistance. Now, they can take no assistance, they can take 2.5% assistance, or they can take 5% assistance. So what that means is that if the customer was purchasing $100,000 house and they took the 2.5% assistance from the state of Ohio, they would get $2,500. If they take the 5% assistance, they can get $5,000. This is for first-time homebuyers, Ohio Heroes, and grants for grads. So if the customer is a first-time homebuyer, they qualify potentially based off of like their credit score and their income. If they're Ohio Heroes, so say firefighter, nurse, teacher, they can utilize these types of assistance. And then grants for grads, if they just graduated, they can get this assistance too. Now, yes. So it's county based. So when we find out what customer, like what county they're purchasing in, we pull up the income for that. The reason why I like OFA the best is because they have one of the most lenient qualifications, and it's also based off of family size too. I know that there's a chart on here somewhere, but I think that
Yeah.
they can go up to like 96,000 with OFA for family or for income, and it's not household base.
Mhm.
So a lot of the other programs like USDA, for instance, will take household income. So like, let's say there's a couple and only one is on the mortgage, we still have to count the other's income, even though they're not going on the mortgage. With OFA, it's only who's on the mortgage. So we've actually taken people off the application, so the income would be lower, so they would qualify for this program.
Mhm.
I have customers that, and I tell every client that I talk to that is eligible for this, OFA isn't necessarily the best program for certain clients because the interest rates are higher. So like, as you can see here, if they don't take any assistance, they're at a 6.125% rate. So who would be like a client that would go through OFA and not get any money? Like, why would they want to do that? And it's because they offer a lower interest rate to the clients, and they're not giving them any money. They're just giving them an additional like lower interest rate than what like currently the market is. So this is sometimes a great program. So if they're a nurse and they want to get a lower program and they don't want to take any money, they're going to get a 5.875 rate, which is lower than the current market. So it's definitely something that people will look into. Now, why do not many people take that? Is because you have to go through a second level of underwriting. So if a customer utilizes OFA financing, they have to go through our underwriting process, and then they have to go through OFA underwriting. It's longer to close, so 45 days. And if OFA is behind, we have no control over that. So I will tell the clients, okay, your difference in your interest rate might be $10. Do you want to have this extra layer of underwriting and process? It's up to the client. It's their choice. You know, all we can do is give them the information, tell them the risks and the advantages, and then they make a decision on whether they want to do it. Now, if you look at the next couple lines here, if they have 2.5% assistance, like for the first time home buyer, it's 6.625, 5% is 7.125. So I have lenders that actually like utilize this as a sales tool, which is not the right thing to do. Buyers call them and they say, hey, we work with OFA. Here's this grant. We're going to give you this money. But what they don't understand is a 7.125% rate is higher than what the current market rates are at now. Like, I think the current national interest rate is like 6.5 right now. So they're paying over 0.5% more to get this assistance. And if they move out of the property prior to 7 years, they have to pay whatever grant selection they pick back. So it's very important to let the client know, these are your options. Again, this is what the grant will cost you. It's never like free money, but we have clients right now that can't buy a house without this program. So is it better than them renting? Well, absolutely, because they're going to start immediately building equity in the property. They're going to get into a home, and they're probably going to be paying less than they would in rent if they own a property.
What's in
Oh, like in a payment? Yeah, I can show you. So let's just say,
what's an example too of this, of someone who would have to take this when you're saying they can get a property?
Yeah,
because they have no money.
yeah, it's really just
They ha-
money or reserves, like
Yeah.
say, for instance,
They
they
have
have enough to
nothing.
cover their reserves,
Yeah.
but not enough to then cover their down
So
payment,
the
closing costs.
minimums- The minimum guardrails for that are like, you need to stay in the property 7 years. Please.
For the standard, but if you're part of the Ohio Heroes program, like, you know, the nurses, the teachers, the firemen, you know, it's only 5 years for them.
Okay.
Yes.
So that's really the, you know, the biggest difference between the two. But back to Zarife, you had mentioned too about the income in the, you know, yes, conventional used to have a lot lower area to moderate income qualifier for that. It was like 50,000 for like a household, but I think they've bumped it up now. FHA's has always been on the higher amount as far as like household income, but I believe conventional is now following suit with OFA.
Can everybody on Zoom see the calculator that I'm using?
Well, there's something in the chat too.
Okay.
Mhm,
Okay, good. Okay, so
correct.
yeah, they do. Yeah, and I'll pull that back up.
Yep, that's where their incentive is for that.
So let's just say it was $100,000 mortgage. They're putting 3% down and they're getting a 6.5 rate without the grant assistance. The payment, the principal and interest payment would be 613. I didn't include taxes or insurance or anything. If it's the 7.125, then they're at a 654. So yeah, so this is what I tell the client, do you want to pay $41 more a month to get $5,000 towards your loan? I mean,
That's 41 for 30 years.
yeah,
Mhm.
$41 for 30 years. So yeah, so let's just do the math. So 41 times 12 is 492 times 30 is $14,760. So they're getting 5,000, but they're paying 9,000 more. So that's why I would always tell the customers, it's not like.
Yeah, it's like they're
Right,
financing it in,
yeah, but you have to look at too,
pretty much.
is the customer going to be in the property 30 years? Probably not, especially if they're first time home buyer. I think it's 5 to 7 years first time home buyer. So like I had a woman, and I think I've used this example before. She came to me from Huntington, and Huntington sold her on this program and was like, you're a first time home buyer. We're going to get you this money. And she lost out on like 2 offers because she was OFA and they had to write a longer closing. And the woman had $90,000 in her 401k. She was buying I think it was like $115,000 house. Like it was no penalty for pulling out her money for a home purchase. So she basically used her own money to put down and didn't go through OFA where her payment was higher. So to her, this was better for her just to use her own money than utilize this program. So every customer is going to be different. It's really about educating and helping the client understand, not just using it as a sales tool, not just saying, hey, we have this down payment assistance program for you. It's helping the client make their own choice on their finances.
Does it assist them differently? Like say, I know a teacher who's been talking to me, it's just someone I was gonna send you who doesn't have that cash base, but she also has like a questionable score, so that doesn't. work,
Yeah.
right?
Mhm.
So I'll show you here right now. So
Yeah.
it shows you, if you look right here, credit score requirements. So conventional USDA and VA loans are 640 or higher,
Okay,
and then FHA loans are 650 or higher.
okay.
They gotta at least meet that.
Yeah,
Okay.
they're also their credit. So I have this little cheat sheet here.
Mhm.
Oh, it's not going to pull up, but that's okay. Oh, now I'm
You're
frozen.
Yeah.
So if the higher their credit score, the higher their debt to income ratio, they can go on these programs. So sometimes people come to me asking for OFA, and the maximum debt to income ratios based, like say they only had a 640 credit score, they can only go to 45%. Where traditional financing, they can go to 50. So they could be also limited on what their buying power is by utilizing this program. So
Is there another down payment assistance program?
Yeah,
So
which I'll
yeah,
discuss that
he's
one
gonna-
here too.
he's going to talk to you about it, but every down payment assistance program has a little bit of tweaks.
Mhm.
This is the easiest, in my opinion. Yes, I
Yeah.
know it doesn't sound easy, but it's the easiest in my opinion. I mean, you could argue with every loan officer about it, but like,
Yeah.
yeah. But I will tell you, like, I've worked for
Yeah.
multiple different companies. I've seen a million grant programs. They all have their tweaks.
The next $41, I mean, of course, it's probably higher for it.
Yeah.
Right.
For an extra $41, sometimes that's nothing to someone that they see.
Yeah.
the idea of
Getting $5,000.
owning their own home. homes that I'm paying extra $100.
Exactly. I
Right.
was just gonna say that, like, I've had customers
Sure.
that are like, hey, if it's, say it's 200,000, they can get 10 grand. Mhm.
Managing 4 kids or something.
Yeah.
Exactly. Yeah.
So I'm assuming military falls into the Ohio Bureau.
Oh, yeah.
Yeah.
Okay.
Yeah. And we do VA loans too.
And that's what I was getting at. The
Yeah.
VA was still gonna affect-
No.
I mean, it's all.
So the rates that we were looking at in like the first box here are FHA, VA, USDA. And then the second is conventional. So conventional is always a little bit higher, and that this goes across the board for even if they're not utilizing OFA. Government backed loans, which are FHA, VA, USDA, they always have a little bit lower of an interest rate. Conventional is always a little bit higher, but they have stricter qualifications to get approved for conventional loans in general. Like that's why a lot of people utilize FHA financing, is because they have higher debt to income ratios. They have lower minimum credit score requirements. Like we can go down to 500. Now, if they're under 580, they have to put 10% down. So basically if FHA, VA, USDA conventional guidelines take it, we take it. I know I say that a lot, but I like to repeat it because we are one of the only lenders that does this. Like there's so many other lenders that put an overlay. And what I mean by an overlay is like, they can say, we're not working with anybody that is less than a 640 credit score because they don't want the loans. They're riskier. The chances of people defaulting with less than a 640 credit score dramatically increase defaults.
Mhm.
So for a conventional picture,
Mhm.
is it the income that keeps a lot of people from being able to go conventional?
Yes, that's a big part of it, because conventional is just a little bit more. I mean, the system that we run everything through, whether it be, loan prospect or a DU, the system is just, it picks up on a person's overall credit profile. Okay. And so conventional is a little bit, of a stricter, I would say, qualifications as opposed to FHA would be in that regard from a debt ratio. Absolutely.
Yeah, and I don't want to make it sound like I know I'm saying that like some of the negatives of this OFA program, but it's not all negative. Like I just like, again, everybody to be aware of like what the disadvantages and the advantages are with working with this program. But, like you mentioned, Zurice, I mean, I have a borrower that I talked to this week and he makes $59 an hour. Like the guy makes a ton of money and he has $500 in his bank account. Like he's got child support that he has to pay and they have kids and like, sometimes we get in our own heads, and I had to learn this a long time ago to like, don't have your opinions when you're looking at these pre-approvals. Like he makes $59 an hour, but he wants to buy a house. So this is good. This is going to be the best program for him. Like he needs the money and he can easily afford a $200,000 house. So I think I issued his pre-approval for like 170 or one something, and he's going to get like $8 grand, just from the state of Ohio. And all he's got to do is live there. He doesn't plan on going anywhere. He's 51 years old. He's not moving again. Like, and he just like, this program is a good fit for him because he has the money to make the extra payment. He just doesn't have the cash flow. So that's why I love that we have this range of programs to help people just get into a house basically. So
Fascinating to me to hear, so thank you.
yeah,
I literally have like 2-3 people right now hearing this, and they're not young,
right.
who could maybe use this, because it's the paycheck to paycheck.
Mhm, for sure. So Cliff is going to talk about the other acceptable sources of down payment, and then he'll talk about the other communities. What?
Yeah.
Do you want to, I think maybe talk about the communities first now.
Yeah, like I said, we'll talk about that first, just since
Yeah.
where it's already kind of hot. I actually sent it to your email. You have
Oh,
it pulled up and
Oh, yeah, I already.
I just sent it
You
so that
sent
way they
the-
can-
oh, the
so that way
communities
they can
first.
see.
Okay.
for you able to see. I know we got lots of things up.
I am really bad, as you can see, with everything that comes up.
Are there any stipulations on this as far as the house, if it's acreage or?
I don't think so. I don't think they have any stipulations, because it's more of just, the property. That's a good question is, there's certain homes that are not eligible for that program. Like I think manufactured homes are okay, but modular homes are not. You know what I mean? So, but I can get you the information on
Can
that.
you guys
That's really the
online
only
see the
thing.
communities first?
Can everybody see?
Can everybody see this document?
They should probably be able to, if you can see the.
Nopers? Okay, so hold on, let me share screen.
Mhm. There it is.
Oh, there we go. Okay, they
There
should
we
be able
go.
to
Yep.
see it now. Okay.
Okay, guys. All right, everybody. Okay, so this is our other down payment assistance program that we do offer. It's through our Communities First program. Now, it has a lot of similarities to, to OFA. They offer 3%, 4%, and 5% as far as income. This particular example here is just for government loans. So this one is strictly going to focus on, FHA, VA, and USDA. Okay, so as you can see, let me scroll down here. These are the terms that they want. These are it's a 30-year fixed, option. For each client that can qualify for them to be able to, to get this type of, down payment assistance. And here we go. They go down to, for their government programs, they go down to a 620. So that's one difference. They go down to a 620 for up to 3% to 4% and 5% as far as their funds. Now, one of the unique different things about this particular program as opposed to OFA is, how OFA is that down payment assistance program acts as like a second mortgage as well. So it's going to go on title. It's going to be recorded as a second lien on the property. Okay. This Communities First program doesn't. This is true. This is a true grant that doesn't get recorded and is not a lien that's on the property. So that's one of the other, positive things about the Community First program as being an option. Okay.
Yeah, definitely forgot to mention that.
Oh, yeah. Yeah, nope. It's all good. So, that's just one of the kind of the things that I wanted to make sure and touch base with you on. So same qualifications, they go off of our findings. So the good thing is about this particular program, they don't really underwrite after they go off of what our findings are. So if they qualify for FHA, if they qualify for conventional, they should be able to qualify for this program as long as they meet all of the, the criteria. Same kind of thing, area to moderate income, those types of things. Allowable properties, 1 to 2 unit property. So you can't have like a 3-unit or 4-unit with this property. Owner occupied duplexes, condominiums, townhomes, and PUDs are all allowed. Okay. But for this program, the ones that are not allowed is obviously this can't be on investment properties, or anything like that, but homes, recreational homes, vacation homes, second homes, motor homes, campers, manufactured housing, those are not eligible for this particular program. Okay. So that's some of the differences. And then let me just scroll down. I'll just kind of go over a little bit of the DTI and minimum, parts of this program. So like I said, as far as findings, if they get approved without any reserves, then they don't have to, have them. So that's a great thing. But they do allow for government programs. This is very rare that they allow for any particular lender will allow for like a manual underwrite, but because really the only programs that are able to be manually underwritten are USDA and VA. Okay. FHA, you can too, but they, as far as for this particular program, it doesn't allow you to have an FHA manual underwrite program. So, but when you do have to manual underwrite, and when I say manual underwrite,
I was just gonna say, yeah.
I should probably go over that
Yeah.
first. That's basically having the underwriter take a look at it before we would be able to issue any kind of pre-approval or approval or anything of that notion. Okay. That means the underwriter reviews what our situation is, what are our compensating factors, what would be reserves, down payment amount, those types of things to be able to qualify potentially, for that mortgage. Okay. So just a couple good, good pointers to kind of discuss, and I wanted to, to chat on that. So, but other than that, guys, that's really the biggest difference between the two is Communities First doesn't act like a second mortgage. It's a true grant that's done. And you have to, but their only requirement is that you have to be in the home for 5 years. Okay. It doesn't matter how heroes or standard, it's 5 years. Okay. To be in that particular home. Okay. And other than that, that's it, I think, with Communities First.
Yeah.
If there's anything else that you can think of that,
No, they
really.
they definitely allow to go lower credit scores. I think they're a little bit more strict with their income guidelines. That's why I like OFA, because if the underwriters look at, the OFA financing and say they had overtime or something we weren't counting, it's a little bit easier to get an approval. But
Yeah,
both really good programs. I mean, we're lucky that we have both of these to offer clients
sure.
that need the assistance to get them in a home.
yeah. I mean, it's, like I said, guys, it's an extra added tool for you guys to extend your buyers and your transactions, for people that need this, we have it for them. Okay, so it's a great program and,
Oh, I-
to potentially use.
And then you want to pull that one up, right?
Yes, then I want to pull
Okay,
up this one
Stop
here real
share.
quick too.
I gotta find where I put it.
And one quick thing too, like OFA guys, Communities First, they set the rates for that program as well. Like Cross Country has nothing to do with the interest rates or how it's priced. It's all set due to the program that we're using.
Yeah, I definitely like to make sure I mention that to the borrowers because, everybody's so
It's a big
rate
point.
conscious right now. And if they think that we're setting the rate, like it just is not as easier. Like it's
Yeah.
just making sure that they understand, hey, like we aren't setting this rate. Cause
Right.
when they see the rates higher, they're like, oh my goodness,
Right.
no.
No, there's no, unfortunately, this isn't a program where you can like standard where you can buy the rate down with points or, or things like that. They're just set on how because they set them. So anybody that does, or that's authorized, I should say, to do an OFA loan or a Communities First loan, everybody's stuck to that same guideline. So you're not going to have different rates with different lenders. If so, then there's a problem.
Like if you, okay, say, it was the 5,000 turned into 14,000.
Mhm.
Correct.
But if you live there, say like 10 years,
Uh-huh.
you would just pay the principal of.
Yeah, pretty much that would all be,
They would just have like a leftover balance and say like 3,000 or 4,000 or whatever you pay that.
it's probably, I think it's actually gone after
Yeah.
7 years.
30 years have to pay that amount.
I don't know
Like,
why.
have to pay that 14,000.
Yeah, if they took it to term. Like if they're only going to be in it 10 years, they're not going to see they're not going to come anywhere near paying obviously all of that. So because it's completely forgivable and gone on their title after 7 years. So it's not like it's going to be on there for the duration of the 30 years or anything like that. Once it hits that 7 year mark, it's gone.
I don't know why I can't get it to
And
pull
that's
up
for the
my
community
files.
first.
Oh yeah, and that's for OFA as well.
So how
Yeah,
do I-
that's for OFA. Communities First doesn't go on as a second lien. Only OFA does. Let's see.
It's not pulling up the PDFs. It's only pulling up my Chrome.
That's weird.
I know.
Let's go to.
Oh, wait, maybe go here,
Mhm.
and then, nope, 'cause it's there, but I don't know how to
Just got-
share it,
Okay, all right.
because I don't think they're seeing that.
Oh, all right, let's see. All right, let's stop share real quick. And then let's see if now that we pulled it up, because there it is.
Oh, there it is.
Yeah,
Okay,
we
good.
just had to enlarge it.
Do you guys see that now, like the types of allowable funds?
Okay, I think they should be able to see it now.
Okay. If you guys can't see it, just let us know.
Okay. Okay, guys. All right. Well, next week, just real quick, 'cause I know we're getting closer to our 11 o'clock hour here, but I just wanted to kind of make sure and go over, some different types of funds, that borrowers can use and really have an idea of, different options for them. And so we can educate them more on, okay, what is allowed to be used, towards, financing. And obviously the first one on here is just, I just wanted to touch on, I know a lot of people know about a 401k, but let's just kind of get into see exactly what it is. So a 401k is employer sponsored retirement savings plan that offers significant tax benefits while helping you plan for the future. So 401k, an employee sets the percentage of their income that wants to automatically be taken out of each paycheck and invested into her account. So those kinds of things. I wanted to make sure you guys, I know everybody knows what a 401k is, but then what really is it? I mean, what the benefits are? Because when you're using a 401k, the biggest requirements is that we're going to need as a lender is to see how much they have in there, okay, how long it's been in there, and what are the terms and conditions of withdrawing it out, okay? One thing that I know Cross Country offers is in some places where if you pull money from your 401k, and they have like a repayment plan, we're not going to factor in that extra payment that they would have to use to pay back their 401k or pay the money back into it. We don't factor that payment into their debt ratio. So that's another good bonus that Cross Country, offers with that particular program. Okay. We still want to make sure we gather the terms and conditions of withdrawal, which is something they can get from the financial institution that their 401k is with. Okay, and just request that because we need that for their file just to show, okay, is this something, does it have to be applied as a hardship loan, or is this something that they can go into? Is it capped at how much they can withdraw? We just need to make sure, especially if we're using it for reserves and not even using it for their down payment, of how can they get access to it and liquidate it. Okay, so that's pretty much why I wanted to at least touch on the basic specifics with 401k and what's the importance of it that people can use.
And this is one of the biggest assets that customers have that they don't realize that they can utilize.
Mhm.
Yeah. It's
Oh, yeah.
a part of the conversation at pre-approval, and half the time I'm getting to the end of the application and I'm thinking like, oh man, this isn't like they have
Mhm.
no money. And then we always ask, do you have any 401k? And the amount, a lot of people utilize 401k services from their employer and they just don't realize that they can use it for this. They're basically using their own money,
Yeah.
to be able to buy a house. So
Yep. And most clients are able to even, that's one of the conditions of their withdrawal is, okay, well, why are you pulling the money out? Because they're going to ask you why you're pulling the money out. And it's to buy a home. That could be on their list of eligible reasons that you can pull money out, and that's one of the greatest things that people, they just don't know about, tapping into that. Once they understand that, this is going to help them and they're using that money that's going into another investment, it just makes it easy for them too. Because don't get me wrong, you're going to get a lot of people that are sensitive. They're like, I don't want to pull out of my 401k. This is my retirement,
yeah.
Yeah, trust me, we get all that. But when you're using it towards another investment that is going to be able to gain you equity and then you can maybe potentially pull from your house at another time, it makes sense. Okay.
And we do have a tool. I know this is off topic real quick, and this would be another workshop we would do. We literally pay for a service that we can plug in the zip code and it will show the client the growth in 5 and 8 years on what their expected equity is to be.
It's so cool.
It's so cool because I just had somebody yesterday that was telling me that they wanted they were thinking about renting still, and I utilized that tool and showed them, and they're like, oh, okay, well, if I sell this in 5 years, I could potentially make 20 grand on my house. Like, okay, let's look into this. So it's not even just the rent monthly, it's the equity that they could be building as well.
Yeah, it's great. So lots of options that we're gonna obviously go over with them guys. So, and now the next kind of point I want to touch on is like an IRA account, which is very similar to a 401k, but an IRA account is what a particular borrower can set up on their own. Okay, their employer doesn't match or put money into it, but this is something that borrowers can do on their own and invest to grow on their retirement. Okay, an IRA is an account that is set up by a financial institution that allows an individual to save for their retirement, tax-free growth, or on a tax deferred basis. Okay, and this is another way where we can track this through a financial institution, through your own IRA company, where we can get statements, we can see how much they have in there, and then we can see their terms of conditions of withdrawal to be able to pull this money out to potentially use, for a mortgage transaction. Okay. And then the next I have on here, I should probably keep this scrolling down too, so they can see. Here we go, is a stock fund or an equity fund. These types of things are kind of unique and not everybody has these, but you will come across that there are borrowers that have lots of these. And so a stock fund and an equity fund is a fund that invests in stocks that is also called equity securities, stocks funds, can be contrasted into bonds, funds, and money funds. All different types of places, guys, where people can have their money into the market. As long as, we can paper trail it and they have the documentation to show how much they have in there, how long it's been in there, and how much they have access to liquidate it, it can be used, as funds for closing. Okay. Same, very similar to like a money market account. Money market accounts are more, I would say, preferred for the everyday, homeowner, or everyday borrower, really, for that matter, that, they can set up through their local bank to kind of see, what they can put money into the market and be able to pull from. So, but a money market is a type of mutual fund that has relatively low risk. compared to other mutual funds and most other investments, and historically has had lower returns. Money market funds invest in high quality, short-term debt securities and pay dividends that generally reflect short-term interest rates. So, but this is another great tool, that's another allowable funds source that borrowers can use, towards their mortgage financing. A very common one, and you'll probably see these a lot, is a certificate of deposit, which is a CD. A lot of people have, either they were gifted this from their family, or this was something that was maybe set up, for them by themselves, or, just the money into the market. A CD is a savings account that holds a fixed amount of money for a fixed period of time, such as 6 months, 1 year, or 5 years. And in exchange, the issuing bank pays interest. So this is something that can help them grow money, over time, that they can have access to later. And then when you cash in or redeem your CD, you receive the money you originally invested, plus any interest, things like that. So CDs are another form of allowable funds that a borrower can use, towards a mortgage transaction, since they can liquidate it. And I spoke on this not too long ago when we were talking about other types of new funds that were available, and it's cryptocurrency. So this is the new age, kind of a digital, currency that, clients have, the ability to invest in and potentially grow money and have, and get some, some extra wealth in those those type of situations. So here's basically a basic rundown on what cryptocurrency is. Okay, so crypto mutual fund is a financial product that is designed to give investors exposure to crypto assets such as Bitcoin. Okay, I still can't say this word. So how do you say that? Anybody know how to spell this? Ethereum. Thank you. I'm like, oh my gosh. I'm like, still to this day, I was like, I know what it is, but I can't say it, through a standard brokerage account. And so, and this is considered digital currency. We want to document the borrower's ownership of the cryptocurrency. This is really the biggest thing, is since this is a unique new type of currency that is allowed to be used, it definitely has to be documented. So this is what's very important. And as far as these next tips for using this. So to document the borrower's ownership of the cryptocurrency, we must document that the purchase was done not by credit card or any other financing type, that it was done by the borrower's own cash investment. Okay, so that's critical. So if a borrower, say, has a couple credit cards that he or she has $10,000-$20,000 lines on them and wants to go buy some Bitcoin and use it to invest and whatnot, it's pretty much worth $0 because they used it with unsecured funds. It has to be cash. Okay, so yeah. So
The easiest way to explain it to a borrower is you can't borrow money to borrow money and use it for a mortgage transaction.
Yep, I mean that's like the
And most-
worst no.
They can't go out and get a personal loan, like they can't do a cash advance, like.
Yeah, can't go to
No,
no.
they can do it and then like let it season.
Yeah,
after.
right, but that's on the low.
Yeah, that's
Yeah.
I did not just say that.
Yep. And then the paper trail, the sale, the conversion of the cryptocurrency, and then the subsequent deposit into the borrower's personal account. So all of those steps, have to be done in order to use that. And
You
so
have to convert it back to cash.
absolutely, yeah. Because unfortunately, there's nobody who's really set up to use digital mortgage funds yet. Maybe someday. So I don't know. Me and Jess will have robots as assistants to help doing those kinds of things. But at some point, it'll be those kinds of things. But that, guys, is some of the the basic things that I wanted to kind of talk about. And then obviously with checking and savings accounts, which we all know, those are the standard options. So because it's easy to track, we're able to look in the savings and checking account for large deposits. If we need season deposits, things like that, we can get all those kinds of things figured out. But a couple other things that are a little bit outside the box, which this has saved a couple of loans from for Jess and I as well, is just talking to them about what things they have. So like secured loans. Okay. And when I mean secured loans, that means it has to be something secured, something tangible that needs to be that you can borrow money from. Like say, for instance, if a client had a car that they own free and clear. Okay. And they made a good amount of money. They just didn't have enough money to come to closing with. Okay. They could actually take a loan out on that car. Okay. And as long as that particular payment went into their debt ratio and still qualify them, they can use that money. Okay. same as it would be if they had a car that they own free and clear or had money on or whatever, and they sold it, okay? That is a secured item that is being sold for cash, okay? So as long as we have the proper documentation from them, which would be a bill of sale, okay? They can get one of those Carfax appraisals, so we know that, you know, that the car, what it was worth that they sold to the buyer from, so there's not anything inflated
Right.
where it's, saying, hey, yeah, this guy bought it for me for 50 grand and the car is worth 20.
Right.
There's
was
some
their
shady
dad.
stuff, with dad or mom or aunt and uncle. Yeah, no. So we got to keep it, keep it real, not shady. So, but things like that. Yeah, a boat. I had a client. He lived on Portage Lakes and owned 2 pontoon boats. He sold one, because he wanted to use it for his financing. So he got the boat appraised. I told him to make sure he gets a check from the buyer of the boat, so we can verify it through that. And I was like, don't do cash, it's too, but it's just, and we had in the bill of sale. So it just makes it easier to kind of paper trail those things when we're kind of walking them through that process, especially if they haven't done it yet, to help it make it easier for them to kind of, to complete that transaction. So things like that. So those are the basic things, guys, that, if you think outside the box and really educate people on different options to use, and then it makes the whole transaction even smoother, because sometimes, if you have a lender that talks to the borrower and just says, hey, if you don't have it in your checking or savings account, I'm sorry, buddy, but you're not getting the house, instead of talking to them about other options on top of, I'm not even talking about gifts. I'm talking about their own personal items that they may have that they didn't know that they could potentially use.
And it is, I think the reason why we did this class is because it really kind of sounds like basic information, right? You're like, you would think that the borrower should just know this, but they don't do this on a daily basis. They don't know that they can pull from these funds. They don't know that they can get gifts.
Mhm.
Like, so for us, because I feel like we're experienced and we're not a bank, we go through this with every client
Everyone.
and every pre-approval, but not a lot of other people don't. So So I feel like there's definitely borrowers that are out there that aren't getting qualified when they could, because they didn't even know that they could ask their mom and dad for a gift, which seems like very simple and very basic because we're in this industry, but the clients don't know.
Right.
So it's important to understand all of these, utilize everything that we can, whether it's a grant program, their own resources, gift funds, to try to get them qualified. Because right now, like, I don't know about you guys, but like, I need loans. So
Yeah.
I think we all need,
I think we all
you know,
need
we all
loans.
need additional leads right now. And so making sure you're educated is so important right now, because not everyone's doing it and they're not talking, and they could potentially not be talking to the right lender, or they need a second opinion to get them more money or
Mhm.
increase their buying power, or, whatever it may be to get them in a house. So these are the easiest tools to use.
Yes, sir.
Refinance from.
That is a great question. I was
Such a
gonna
great question.
absolutely just, jump onto that
Yeah.
next. So
So
yes, you can, but it's gonna be very similar to, like having a home equity line of credit. Okay. So there's been a lot of times where a person that has purchased a house, OFA, forgets that, like, oh yeah, I still have that, that mortgage on there that's not within the 7 years. So they basically have to have it subordinated. Okay, it works as like a it basically has to stay in second lien position.
with OFA, they have to pay it off.
Yeah,
Before they can refinance.
yeah.
Correct.
After 7
Yes,
years, they
because
can
it's paid
refinance,
off and
gone.
clear.
Right.
Yeah. But there was a lot of clients before 2020 when the rates dropped and they utilized OFA at like 6% and 7% rates. And then when the rates dropped to 2% and 3%, they had to pay that back. But if you did an amortization over the years of going from a 6 or a 7 to the 2 or 3, a lot of people were pulling money from their 401ks to pay off that grant, so they could get the lower financing because their payment was dropping so much. I mean, a lot of people made the up for the grant in 2 years because their payment was dropping $100 to $200 a month.
Yeah, so it made
So-
sense to refi it.
Yeah, but we always look at an amortization schedule for the client to make sure it's in their best interest to refinance. I can't even tell you how many people will just try to push refinances and the customer doesn't understand what it means. All they hear is like rate, oh, I'm
Mhm.
going from a 5% rate to a 3% rate, or I'm going from an 8% rate to a 5% rate. And they don't
Mhm.
understand that there's cost to refinance and that there's a break even point. So
Yeah.
again, there's a lot of shady lenders out there.
And it changes their program
it-
because they go from a rate and term to a
Yeah.
cash out, which is gonna affect their pricing for
But-
their interest rate
But this
too.
is, and I always teach on this too, like when the rates do start falling down, like here shortly, we're hoping, this is a good way to reach out to the people that you've closed, the transactions that you've closed, and just touch base with that client saying, hey, you know, you bought in this year, it might be a good time for you to refinance. It's just another reason for you to call them and then reconnect them, because if you're saving them money by refinancing, like they're going to remember you as their realtor that not only sold them a house, but also educated them about getting a refinance and could get them into a better,
For sure.
you know, a better loan.
It's an extra
program.
touch for you guys,
Right.
you know, to be in contact with them. You're like, hey, you know, they actually called to say, hey, I can save money.
So it's 11:01. We did really good on time because
Yes.
I feel like I could talk so much.
Yeah.
So, any questions? I know we didn't leave much time for questions, but any
Let's see.
questions from anybody online?
Just make sure and check the
Yeah, check the chat.
chat lot.
Okay.
Okay, I think we're good.
Yeah,
Okay.
anybody on questions on the OFA grant assistance, down payment, any of it?
Communities first, different types of assets or funds. Yes. Uh-huh. If somebody sold their boat and wrote a receipt for the sale, it just has to, it has to be a bill of sale. It has to
Yeah.
show, okay, yeah, here's my boat, you know, it's a 1820 turbine, you know, pathway, something like that. What the sales price of it was, and it all has to be on there, who
A
they
copy
sold,
of the title
Yeah.
showing that they owned
that they
it.
owned it.
And then we have to do a like Carfax, or I don't know what they are for boats, but there's something to verify like the value of boats. So you can't,
Mhm.
like he was saying, you can't sell a car for $50,000 if it's worth 20. Like the underwriter's not going to give them credit for that. They'll give them credit for what the market value of the property is.
Right.
I mean, there's
Yeah.
features that you can add.
Yeah,
like,
you add all that
you
into
can
the
add
appraisal.
that into the Appraisal. and-
Yeah. So if the boat's got spinners on it, you
Yeah.
gotta think it's gotta be worth a little something extra. You know? So, but yeah,
But
so,
thank you guys all for coming.
Yes,
If
thanks
you
for
have
coming,
any
guys.
questions, let us know. We're more than happy to answer anything on what we talked about today.
all right, guys, and I think this was recorded, so if anybody wants to listen to it again, or if they want to share it, they can just go back and listen to our class.
All right. Thanks, guys.
All
Have a
right.
good day.
Thanks. I think you gotta hit the pause.